I don't see that anywhere. I haven't heard about that. And look, one of the reasons we left our company in Minnesota, our corporate office, like we're seeing up 30, down 30, they can raise the percentage that you need on margin. And that's when it really bites. And because now you're getting squeezed from both sides, higher prices and higher margin rates. But here's why it's bullish. And to me, it's bullish because margin hikes don't stop physical demand. And they reduce the ability to run giant positions just on thin collateral, where you can control massive positions by having a small margin account. And so, yes, you will get a paper flush when this is implemented, like we saw, 5% retracement in a couple of days. As contrived and disgusting as it is, it's already come back, 30%. Still a long way to go. But yeah, it was done for these reasons. And when that happens, the players around the world say, hey, thanks. We'll stand for delivery on some more. And you may be very well heeled. Our company is very well heeled with the ability to have a massive inventory and the margin requirements needed for it. But if it kept going up, how much can we post? At what point does it just destroy the ability to maintain an inventory? And that we're not making more money when the price falls. We're sharing that risk with you. But understand this as well, that all of the logistics in and out and hedging and accumulating and the panic, and it's magnified at a level I've never seen before. What we did in the month of January, the closest I can explain to it would have been when Silicon Valley Bank failed.
It's been far too long since we've had this guest. Andy Schectman is the CEO of Miles Franklin Precious Metals. He joins us nominally every week for a weekly market update, but it's been 3 weeks. He's back here again. Andy, thanks for joining us again on Liberty Finance. Today is Monday, February 9th, 2026. Thanks for coming back on for this weekly market update.
It's great to be back, done again. I had some travel, both for work, for fun, and I appreciate you bearing with me. But of course, while I'm gone and trying to relax, the world seems to fall apart from underneath. But don't worry, it all is okay, I assure you. But we'll talk about it. It's good to be back, my man. Good to see you.
Glad to have you back, and we definitely are going to hit that as our main line topic tonight, is what in the world happened to the metals markets over the past 9 days. We're going to get into that. First, we wanted to recap quickly a cover back to a topic that we brought up briefly in passing about. It was actually raised by a client when there was this huge run up in silver prices over $100, and the U.S. Mint suddenly shut down and said, okay, we're not going to sell stuff until further notice. And they fixed their prices and jacked up the prices again from their uncirculated silver eagles and their proof silver eagles by a lot that they hadn't adjusted in a long time. And we had some concern about what's the difference between a BU, or brilliant uncirculated silver eagle, purchased through Miles Franklin or other dealers versus the uncirculated silver eagles that are sold by the U.S. Mint. And if you can enlighten us on what the difference turns out to be.
Yeah, I guess it's just a frosting on top of the BU, or the uncirculated, the BU coins that we sell. The commercial strike, I guess, just don't have this frosting, which is nearly impossible to discern between the two. In essence, it's lipstick on a pig, and there's no reason to buy the uncirculated coin from the U.S. Mint, because the brilliant uncirculated coins, uncirculated being the U in BU, that you're getting from any dealer like myself, is just a better value. I guess if you're collecting it as part of a set, where you're collecting the proof and the uncirculated coin as issued by the Mint, one set or whatever each year, fine. But again, anything that you're buying from the Mint is not really economical from the standpoint of building your core position. It's more along the lines of things that you want to collect. And most of those things won't return their value. Some of them will, I guess. Some of them are made in very small quantities, and maybe they will, but certainly that's kind of the sprinkles and the hot fudge on top of the vanilla ice cream, which would be just the normal commercial strike, where you're getting more content rather than frosting, so to speak.
Yeah, that finish, ironically, many people who see and hold and touch for the first time one of the BU American Silver Eagles or other government minted BU coins that we sell are just blown away by the beauty of the engraving. The mirror-like finish is one of the things that attracts them. So you could get a frosted finish if you don't want the mirror-like finish. But as you point out, you're going to be paying a huge markup to get that from the U.S. Mint, and it doesn't always pay off in terms of investment value. So for your core position as an asset, the BU, Brilliant Uncirculated, with the mirror-like finish that you can get from Miles Franklin and other reputable dealers, is the way to go for the bulk of your holdings. We also had a question for you that's been submitted by a number of different customers in the past week. They're running around. We had 3 very concerned clients reach out last week and another one today saying, I've got to get this done quickly because there's going to be this new federal government reporting requirement that's going into place on February 14th, and we got to get this done right now, but I have to make sure that I don't go over the limit because the new reporting limits and everything's going to be reported to the government by every dealer after February 14th. Can you tell us the truth about what's really going on? Any change to reporting?
Yeah, I mean, I don't see that anywhere. I haven't heard about that. And look, one of the reasons we left our company in Minnesota, our corporate office, is, even though I'm in Florida where we've had this satellite office for 15 years, I could have moved it out of Minnesota, out of the craziness there, and saved money, but I left it there because we're held to a higher standard through licensing, bonding, continuing education, compliance, and this has not been brought to my attention anywhere, and I've looked for it and can't find it.
This segment is critical for investor psychology. Misinformation is driving artificial panic and poor decision-making. The myth: new federal reporting requirement starts February 14th. Dealers must report all precious metals purchases to government. Buy now before the deadline, or you'll be tracked. The reality: there is no new reporting requirement. Dealers have always reported transactions above certain thresholds via IRS Form 1099-B for specific products and FinCEN Form 8300 for cash transactions 10K plus. Nothing changes February 14th. Nothing changes at all. Schectman emphasizes Miles Franklin operates in Minnesota with licensing and bonding. They're held to higher regulatory standards than most dealers and have been reporting appropriately for decades. The February 14th date is fabricated, likely spread by either 1. Unscrupulous dealers using fear to create false urgency, buy now before tracking, or 2. Genuine confusion conspiracy theories circulating social media. The danger: investors making rushed decisions based on false deadlines, potentially overpaying or buying inappropriate products. Schectman's debunking is public service. There is no rush, no new requirement, no reason to panic buy based on reporting myths. The only rush is March delivery squeeze. Different issue entirely. This misinformation reveals how easily precious metals investors can be manipulated by false narratives. Critical thinking and trusted sources essential.
Now, there are several of these Asian guy channels. The one that I follow that I think has the best information, at least so far, again, I haven't followed all of them, but the OG John Agee, the original John Agee, he's one I follow. He didn't say this. It was someone else that, I don't know. I can't see it anywhere. It's created nothing but anxiety, and I can't even figure out why they would have said it, other than maybe try to get people to sell before, before this mandatory reporting comes in. But to my understanding, to my own research, to everything my compliance department has told me, there is no such law that has been placed, and it's, for whatever reason, misinformation as far as I can tell.
Now, there has been a change. July 1st of 2025, there was a relaxing of mandated dealer reporting for 1099-B capital gains, so that a lot of people's, if they have a personal financial advisor or a tax advisor who isn't up to date, they may still be going off of what had persisted for years and years and years. There were about half a dozen or 8 different categories that would trigger reporting limits in the past. Now it's just down basically to 1 limit for silver, 1 limit for gold, 1 limit for platinum, palladium. Basically, it's a certain number of bars in aggregate.
That a certain number of bars in aggregate in one transaction that would satisfy a COMEX contract. 5 1,000-ounce silver bars, 3 gold kilos, or 1 100-ounce gold bar in one transaction, which is the definition in both cases of a COMEX deliverable contract. So anything other than that, no reporting.
So that's actually less reporting than there ever was in the past, because it used to be there was 25 gold Canadian maple leafs or 25 gold Krugerrands or $1,000 worth of face value of junk silver. So if people want to get the new reduced reporting requirements for 1099-B, which dealers are still mandated to follow if individual transactions go beyond those for those very few examples, just email us at libertyandfinance, all spelled out, all one word, libertyandfinance at protonmail.com. Just put 1099 in the subject of your email. Please put your name in the email so we know who we're responding to, and we'll be happy to get back with you and send you that reduced list, a very short list of mandated dealer reporting, which only applies to COMEX contract size amounts of bars in either gold, silver, platinum, palladium. Does not apply to any coins at this point, or rounds. So very interesting. Actually less reporting and yet more noise being made about it all over the place. Okay, so let's get back to the main headline topic of the day, and that is what in the heck happened over the past week and a half. We were on our way into a cloud nine new reality of metals prices. People said new price discovery is finally going to happen. The physical markets have taken over and fundamentals are driving this. And then all of a sudden the trap door opened and the bottom fell out. Now looks like there may be some floor being found, but can you tell us what we know about what happened and what we know about where we are going at this time?
Yeah, I'm just looking to see what silver is at today. Haven't looked yet.
It was 83.5 last time I looked.
83.97 I show right now, up 571, and gold at 5,081.50, up $110. At 84 bucks, I mean, we were at 65 on Friday night. So here we are, that's over 30% right back. I think what people need to understand is, first of all, the CME group raised margins to all-time highs. Raising margins is, first of all, people think it's very bearish. In my mind, it's not bearish. It's the exchange telling you that this move is real and it's getting violent. It's bearish at first because the amount of money needed to hedge positions increases exponentially. They've raised it twice right around Christmas, a few days before and the day after. It was like $18,000 to hedge 5,000 ounces of silver right around Christmas time. The day after, it went to 27,000 ounces, and now we're above $53,000, $54,000, $55,000 to hedge 5,000 ounces for a company like ours that would normally have 2 million ounces of silver in the warehouse. Becomes very expensive. You better have $50 million in your margin account, or you're not going to keep much in the way of hedged inventory of gold and silver. But this is also true of speculators. And, the margins are a percentage of the contract's value. So when gold and silver go up, the contract gets bigger and the margin requirement goes up automatically. That's a new thing. It used to be a fixed rate. Now they're making it a percentage. So, the math does this as the price goes higher. Okay, that's fine, but they're also adding volatility into the equation. And when the market starts getting swinging, like we're seeing up 30, down 30, they can raise the percentage that you need on margin, and that's when it really bites. And because now you're getting squeezed from both sides, higher prices and higher margin rates. But here's why it's bullish, and to me it's bullish because margin hikes don't stop physical demand. What they stop is paper leverage, and they force the weak hands out.
This segment reveals the two silver markets. One, paper market, futures, options, unallocated, 100, 200x leverage. Price discovery happens here, margin requirements matter, speculators forced to sell regardless of fundamentals, price sensitive. 2. Physical market, coins, bars, allocated. No leverage, actual metal changes hands, margin requirements irrelevant, buyers purchasing for wealth preservation, not speculation, supply sensitive. When margin hikes crash paper silver, physical market doesn't follow. Why? Because physical buyers aren't leveraged. They paid cash, they own metal, they can't be margin called. The divergence shows up in premiums. Paper silver might crash 25%, but American Silver Eagles still trade $6 to $8 over spot. 1000-ounce bars still have 2 to 4 week delays. Physical supply didn't increase despite price drop. This proves paper price is disconnected from physical supply-demand fundamentals. The mechanism: over-leveraged speculators hold to one paper silver, margin hike forces liquidation of 95% of their position, price cascades down, but physical buyers see this as opportunity. Silver just went on sale 25%, I'll buy more coins. So physical demand actually increases during paper crashes. Eventually, physical scarcity reasserts itself and price rebounds, often higher than before the crash, because weak hands transferred to strong hands. The March delivery squeeze is this process accelerating. Paper sellers will be forced to deliver physical they don't have.
And they reduce the ability to run giant positions just on thin collateral, where you can control massive positions by having a small margin account. And so, yes, you will get a paper flush when this is implemented, like we saw, and futures can and did drop when the leveraged traders are forced to liquidate. But that's not the end of the bull market, that's the shakeout. And the people that have been standing for delivery, as I've been really screaming about for quite some time now, for 15 straight months, so they're not using margin. And so these are the big money, the banks. Could it have been one last attempt to bail out some of these U.S. banks who still had? Now, we've been talking about the Commitment of Traders report that said the U.S. banks are net long. We've talked about the report that came out of the Economic Times that said the banks are net long. But being net long doesn't mean you're long only. That means you have more long than you do short. Now, could this massive price rise and all of this attention that we've been seeing on silver precipitate some concerns by some very big players in a coordinated fashion? They raise margins and smack the crap out of it? Yes. But what they really did was they chased leverage out of gold and silver. And when you do that, you don't make those that are holding said metal weaker. In my opinion, you're putting it into stronger hands. And so, that's kind of the tell to me. And margin hikes don't end bull markets in metals. In my mind, they usually mark the point where the next leg higher becomes inevitable because now it's in strong hands and the price is now moving up. I want to give you kind of what I mean by that too. So this is kind of one of the moments where the market confesses. And you had the biggest one-day drop in silver maybe ever. And everyone got emotional. People are screaming and panic and, they assume demand vanished. But this is how these idiots work, okay? The very next day, SLV takes in the largest one-day metal inflow in years. Dunnigan, that's not panic buying. That's institutional metal transferring at a discounted price.
The SLV data is mathematical proof of strong hands accumulation. SLV, iShares Silver Trust, is physical-backed ETF holding 500 million ounces. When institutional investors buy SLV shares, the trust must purchase physical silver to maintain backing ratio. The sequence: 1. Largest silver drop ever, 25% in hours. 2. Retail investors panic sell everything, futures, miners, SLV. 3. Next day largest SLV inflow in years, tens of millions of ounces. 4. This means institutions bought SLV shares, forcing trust to buy physical silver at 25% discount. Who are these institutions? Hedge funds, sovereign wealth funds, pension funds, family offices. Patient capital that understands precious metals as wealth preservation, not speculation. They don't use leverage, don't get margin called, and view volatility as opportunity. The wealth transfer. Retail investor bought silver at $30, panic sold at $22.50, minus 25% loss. Institution bought at $22.50 through SLV. Silver returns to $30, institution gains 33 cents plus. This pattern repeats every cycle. Volatility transfers wealth from emotional traders to disciplined institutions. The SLV mechanism is important. Unlike futures, which are 95% plus cash settled, SLV requires physical purchase. So institutional SLV buying directly removes metal from market, tightening physical supply. This amplifies future price moves. Less available supply means higher prices when demand returns. Schectman isn't celebrating retail losses. He's documenting how markets transfer wealth and urging investors to be the strong hands, buy volatility, hold physical, ignore paper crashes, instead of being the weak hands, sell panic, chase momentum, get shaken out.
And what I mean by that is that you had 550 million shares outstanding the day before it dropped. The day after, it goes to 587 million. So that's a 36.3 million new shares that were created at roughly 0.905 ounces per share. That's about 33 million ounces of silver added in one day. And the authorized participants are the only one who can create those shares, and they can only do so by delivering physical metal first. So think about really what that means. Silver gets smashed, and immediately after the smash, tens of millions of ounces show up inside the ETF. This tells you that someone with a real balance sheet used the forced liquidation, this margin event, to source physical metal cheap and park it where they control it. And they control it inside of the ETFs. And this is metal migrating from forced sellers to the institutional vaults, because these institutionals can do what's called share redemption, and they can redeem their shares if you're an authorized participant in metal, and it's far more opaque than it is transparent. And it's just another mechanism they have to drain physical metal out of the ecosystem. But when you line up the delivery pressure that we're seeing, the tightness in the registered inventories, which I want to talk about in a moment, all of this stuff, including what's going on in the ETFs, this is not normal flow. That's inventory reshuffling under what I think is major stress. And, Richard Russell used to say something like this to me. He used to say that markets don't reveal themselves during the violence. They only reveal themselves after. And where price is the weapon, freaks everyone out, but the inventory is the confession. The confession is we really don't have it, but we need to freak everyone out by flushing them out with price and margin increases. But nothing has changed. In fact, now you get into this Project Vault that's come up where you got the U.S. government that is acting very much like silver is not plentiful. It's acting like it's strategic. Of course, they call it a strategic metal right now. We've had 6 straight years of a deficit, of course. It's been added to the critical mineral list, but now you got this Project Vault, a brand new U.S. critical mineral reserve. It's obvious that they're worried about disruptions, and they call it a public-private structure designed to stockpile essential raw materials inside the United States to protect supply chains. That means they want to incentivize domestic mining also. So you put a floor under the price.
COMEX Futures Exchange has 2 inventory categories. 1, eligible. Silver stored in COMEX warehouses but not available for delivery. Owner doesn't want to sell. And 2, registered. Silver available to fulfill delivery demands, owner willing to sell at contract price. The squeeze happens when open interest, number of contracts that could demand delivery, exceeds registered inventory. Current situation per Schectman. Open interest represents 80 to 103 million ounces of potential delivery demands, but registered inventory only 40 to 50 million ounces. That's a 201 shortage if everyone stands for delivery. What happens in squeeze? 1. Longs, buyers stand for delivery demanding physical metal. Shorts, sellers, must either deliver physical or buy back contracts at any price to close positions. 3. As registered depletes, remaining sellers panic. 4. Price spikes explosively to ration scarce supply. 5. Or exchange changes rules, raises margins, limits delivery, cash settles to protect shorts. This is the manipulation Schectman references. March is primary delivery month, meaning most contracts expire then. This concentrates delivery pressure into 4-week window. The volatility around margin hikes is related. Exchanges trying to shake out longs before delivery to prevent squeeze. But if strong hands don't sell and demand delivery, Exchanges face crisis. Not enough physical exists to fulfill contracts at these prices. Historical precedent: 1980 Hunt Brothers silver squeeze, 2021 nickel squeeze, LME canceled trades, repeated gold delivery squeezes. This isn't conspiracy theory. It's documented market structure failure when paper claims exceed physical supply.
And then you zoom out, you look at COMEX registered as the delivery pile, which is massively lower than a few years ago, and the LBMA is being bled dry. Demand is rising, supply is constrained, and the world is treating silver like it's a strategic input. They're admitting this right now. And so I think that, when governments start stockpiling, the message is simple. The scramble for the real stuff has begun. And if that's really what they're going to do, you better clean up your balance sheets if you're wickedly short. Maybe that's what this was about. But I can tell you that nothing changed. There are no fundamentals that changed at all. In fact, maybe they're even getting stronger. And what I mean by that, last thing, and I'll take any questions that you have, the March silver contract is really shaping up to be really interesting. Right now, the March silver contract open interest, meaning contracts that could stand for delivery, is between 80 million and 81 million, right around 80,500,000 contracts open interest. Now, I suppose that kind of sounds abstract until I tell you that each contract is 5,000 ounces of silver. So that's over 400 million ounces of paper silver that is tied to the March contract. The first day that they can stand for delivery is the 27th of this month, so 2.5 weeks away. But if you compare that to what is actually sitting in the COMEX, the registered category as of yesterday is 103.5 million ounces registered, meaning ready for delivery metal is 1 out of every 4, is that right? 1 out of every 4 ounces, 402 million ounces could stand for delivery, standing against 103.5 million ounces. Now, typically, most of these contracts will roll forward or cash settle, but if even 10% of the March open interest stands for delivery, that's 40 million ounces. If 20% stands, that's 80 million ounces. Suddenly you're looking at a massive chunk of the registered category, and the market has to react. So the bullish bet isn't that COMEX defaults. I think it's simpler. I think that it's the price of immediacy rises, backwardation, the spreads tighten, and the market has to pay up or pull metal out of the eligible category, which is the other side of COMEX, which right now has 294 million ounces. So we have a Brinks account in New York City, JFK, one of our 8 Brinks facilities. That's COMEX. It's the only one of our 8 Brinks facilities that is a COMEX facility. And we have plenty of people with 1,000-ounce bars in those accounts. Those are eligible. They're not for sale. They could be because they are COMEX eligible. They're in the ecosystem. But no one's going to sell on my side. And all the people that are holding them ineligible, that's not for sale. So even if all of that metal went in, you're talking right now 294 and 103. You're about 99% of open interest right now. And it's all gone. But most of that eligible stuff isn't for sale. The point I'm getting at is that you see what's happening in London. We see that. We've talked to David Jensen, talks about 2 billion ounces of open interest contracts standing against 120 million ounces of physical. You see it right here, 103 million ounces of physical that is standing behind 4 million ounces or 400 million ounces of potential delivery. You see the exchanges being bled dry in Shanghai. You're seeing games being played on the ETFs. You're seeing margin hikes. And all along, the big money doesn't give a flying you-know-what. They just keep standing for delivery. It's the traders who think that they can play in this sandbox with these people who money doesn't mean anything to them. And you may be very well heeled. Our company is very well heeled with the ability to have a massive inventory and the margin requirements needed for it. But if it kept going up, how much can we post? At what point does it just destroy the ability to maintain an inventory? So what they're doing is they're squeezing out the players who think that they're big enough to play in this game. And really what is happening is you are seeing a strategic repricing that is forcing out the speculators and putting it into the hands of the big money who is standing for delivery. What more do you need to see but that? It's painful. It's scary. Fear is a very, very strong emotion, probably the strongest. And when you see this fall, you get emotional. This is why there's Elliott wave theory and Kondratiev wave theory, the mass emotions of the herd. Separate yourself from your emotions and look at the reality. Nothing's changed. In fact, every day it's getting more and more and more obvious that this is where you need to be. Now, what just happened was contrived. It's BS, should have never happened. Where were the stops on the
circuit breakers on the market? Yeah.
The circuit breakers. So they have reasons why it didn't, and they're using the millisecond thing, a bunch of nonsense, right? They stop it when they want. This was contrived. It was done to, I think, probably either at the same time flush out all the speculators and bail out some of the short positions by the big money. You can't keep doing that. When you see this huge arbitrage going on in China, you can't do it. All of that metal will arbitrage away from the COMEX, from the LBMA. If I had to guess now,
This is the core thesis. Margin hikes are bullish, not bearish, when understood through market structure lens. Here's the mechanism. Precious metals bull markets attract two types of participants. One, weak hands. Over-leveraged speculators using futures for 21 leverage, paper profits only, force sellers when margin requirements rise, and two, strong hands, institutions, sovereign wealth, physical buyers, patient capital, buy volatility. When exchanges raise margin requirements, the capital required to hold futures positions, weak hands can't meet margin calls and are forced to sell, creating cascading liquidations and price crashes. But this forced selling doesn't destroy silver. It simply transfers ownership from weak to strong hands at discounted prices. The largest one-day drop ever, followed immediately by largest SLV inflow ever, is mathematical proof of this transfer. Retail speculators panic sold. Institutions calmly bought millions of ounces through SLV at 20-cent plus discounts. This pattern repeats throughout precious metals history. 2011 margin hikes, 2020 COVID crash, 2008 financial crisis. Each time, weak hand liquidation preceded the next leg higher because strong hands accumulated supply. Schectman isn't being contrarian for its own sake. He's reading market microstructure that professionals use.
I'm really stupid to say this, and I'm actually reluctant to say it, but I will say it. If I had to guess, by March, you'll see silver back at all-time highs. If I had to guess. Now, what do I know? But based upon what I see, the 30+% swing back today, boom, no, why aren't people freaking out when it goes back up 30%? Yeah, we'll get back up there, and I think it'll be buyer before March if I had to guess. And all that happened is that the metal went from weak speculative hands who were holding lots of leverage to the big money that says, thank you so much for that discount. By the way, I won't be standing for any margin. I'm just going to pay cash for it. And if you look, who covered almost 700 contracts at 5,000 ounces apiece at the very, very bottom? Oh, that's right. It was JP Morgan. How foolish of me to think otherwise. Do you get it? The big money is still in control, but they are showing you where this is going. Not ending the bull market, just kind of showing the big traders who's really in charge, and that is the big money, until things get to a point where it's no longer about the ability to control things on paper. It's more about really who's got the physical. But there has to be a transition to get there, and I think that's what we're seeing right now.
There are several takeaways from that I wanted to drill in with you with your help, and you've already brushed up against a number of these. The first is this notion that has persisted for some years, is that there's a global coordinated market. There are different, there's the New York, there's London, there's now Shanghai and Moscow and wherever else. But basically it's a global market. But what we've seen is this fracturing of that, where we now seem to have these regional breakaways where you have price discrepancies opening up between these markets, because without physical liquidity, when the liquidity gets squeezed down to the machine's almost running dry, there's no oil left to lubricate the pistons, it seems like there could be screeching dislocations in price and a breakdown of this assumption that we have a smooth functioning global market. Do you want to address that idea of the breakdown of globalness into a fractured market with regional differences in price?
Yeah, I think globalism is dying. I think we're becoming more mercantile, where, it's about protect your home first. I think that's what this is all about to a degree. Globalism isn't working for us so well. And I think that's why you're seeing the rise of all of these exchanges and the idea of what the BRICS are talking about. And for people who poo-poo the BRICS, I'm tired of it. In fact, I talked about it at Vancouver Resource Investment Conference, and I had Nomi Prince backstage saying, you're right. And she's one smart lady, and she said it right there on stage with me too, and that is that all of these countries are using their local currencies over things like Enbridge or the SIPs, the cross bank, or what is it? The cross interbank payment system, something like that. Well, both of these platforms are free from SWIFT intervention. And when you get institutions or entities like the Asian countries, the ASEAN, the acronym, those countries in Southeast Asia that have 800 million people, that have twice the population of the U.S., that are China's largest trading partner by far, 30+% of global GDP, using these systems, well, you're no longer settling in dollars if you're using these systems by a massive entity of people. And then at the same time, and maybe they are some dollar settlement, but a lot of it is now going elsewhere. And which begs the bigger question. When you have all of these transactions being done in dollars, you have reserves. Those reserves are then usually put into treasuries to make interest on those reserves with safety and liquidity. But now they're not doing that because they don't have the reserves. They're using other currencies. So they're not buying bonds. And instead, what are they all settling imbalances in throughout the BRICS and the expansion of all these vaults? Gold. And that is the whole premise of their new payment system, is to trade local currencies over Enbridge or SIPs or any of the other payment systems that they've all designed that are free from SWIFT intervention, and settle imbalances, whether it be currency or trade, in gold through a set of multi-jurisdictional vaults. Moscow, Shanghai, Singapore, Dubai, all of them at the BRICS vaults, and all of those that will be built, the one that was just built in Hong Kong and now the one being built in Saudi Arabia, well, they're all for the same game. Trade your own currencies, defend your own ecosystem, build your own monetary future from within instead of strengthening that of the United States, settle imbalances in gold instead of treasuries. The settling outside of dollars chips away at the dollar settlement status, makes the dollar fall, and the lack of purchases of treasuries, well, chips away at the reserve status. So this is a slow, little by little process. But I do think that is exactly what is happening, is that you will see a world that embraces gold as a settlement vehicle. And at some point, real price will matter. And if you're trying to accumulate it, you just play the game of the West. Go ahead, be stupid enough to knock it down. We'll stand for delivery. And if you're not going to deliver to us, we'll incentivize you through massive arbitrage by having a price that is much higher than it is in the West. So you'll think twice when you can deliver me 50 million ounces of silver at a huge vig, and then go buy yourself, a couple of yachts and live in Tahiti forever, because that arbitrage is significant and it's unrelenting. They're not letting it go away. Normally, arbitrage is settled when the business will flow to the arbitrage and it'll balance out. But they're leaving it there. They're taking all of their dollars that they're choking on and saying, fine, we'll still keep the price higher here for delivery in Shanghai. And people say, well, there's this tax that's involved. They don't know what the hell they're talking about. It's not true. The tax is eaten by the Chinese. The tax, when it is delivered onto the Shanghai Metals Exchange, there is no tax. It is when it is taken off the Shanghai Exchange, where there is this excise tax, or they're talking about this import tax, or whatever, the VAT tax that everyone says, well, you add the VAT tax into the metal price, Well, there's not that much of an arbitrage. Not true. When the dummies in the West buy paper and deliver the physical there, that tax is paid by the recipient of the metal when he pulls it off of the said exchange. So it's happening, to your point, Dunnigan, and the West is being exploited for their stupidity for playing these games. And they have been for a long time. And you and I have been talking about that since 2020 to one degree or another. And now it's kind of getting to the end game. So if there are still some players offside that the West doesn't want offside, well, an event like we saw, a 50% retracement or 45% retracement in a couple of days, as contrived and disgusting as it is, it's already come back, 30%. Still a long way to go. But yeah, it was done for these reasons. And when that happens, the players around the world say, hey, thanks. We'll stand for delivery on some more. And watch what happens on the March delivery. You're already seeing big volume on the February delivery. So, and March is a primary delivery month. So I expect some fireworks leading up to March. And that's why I think we have a chance to see much higher prices into March.
March delivery timing is critical. Futures contracts have delivery months when longs can demand physical and shorts must deliver. Silver's primary months are March, May, July, September, December, March being largest. Current setup: 1. Open interest elevated, many contracts outstanding. 2. Registered inventory depleted, low deliverable supply. 3. Margin hikes shook out weak hands, but strong hands remain. 4. Physical demand robust, SLV inflows, coin sales strong. 5. March delivery deadline approaching. The volatility can go both ways is key. In normal markets, low supply, higher prices gradually. In squeeze markets, low supplies, forced delivery, explosive price spikes. Historical examples: silver March 1980 spiked to $50 in weeks. Nickel March 2022 spiked 250% in days, forcing LME to cancel trades. The binary outcomes: 1. Price solution. Silver spikes to $40, $50, $60 to incentivize physical holders to sell into delivery. Shorts cover at massive losses. Longs profit enormously. Market clears at higher price. 2. Rule change. Exchanges panic, raise margins further, implement position limits, force cash settlement, or suspend trading, protecting shorts at expense of longs, preventing squeeze but destroying market credibility. Schectman expects much higher prices because physical scarcity is real, not manipulated. Delivery demands will be substantial. Strong hands want metal. Registered can't meet demand at current prices. The into March phrasing means price appreciation before delivery. As squeeze becomes obvious, front-running drives price higher. Whether it's orderly rise or chaotic spike depends on how exchanges respond. But either way, strong hands holding physical win.